Good morning, everyone. Tim Nyland here. Today is Wednesday, March 31st, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. And don't forget to hit the subscribe button below to make sure you never miss any of our future calls. Today, we're going to pick up on the final installment of our growth stock valuation analysis series in a rising interest rate environment. Today's webinar, we're going to focus on Highfliers on the slide. And this is basically part 3 of the Will Rising Inflation Sink Tech Stock series. I have an image on the screen of our YouTube channel, and you can find the previous 2 videos highlighted here in the red box. So the first one being Will Rising Inflation Sink Tech Stocks, and then last week's webinar of evaluating high valuation stocks as inflation fears grow. And again, as in any of my weekly strategy calls, this webinar deck, the slide deck that you see on the screen, is available. If you'd like to receive a copy of it, please just send us an email. All of the contact information will be at the end of the webinar. I've also been having a little bit of trouble with my voice over the last week or so, so if you hear a little bit of an extended pause, it's simply me grabbing a drink of water. I apologize. Today we're going to have some fun. I was reading a Wall Street Journal article either in yesterday's journal or the day before, and it was titled "Stocks Viewed as Beneficiaries of Recovery Start to Lose Steam." And the interesting thing about this article, and it's actually the basis for today's webinar, is that I found a very interesting mix of stocks being mentioned in this particular article with no mention of valuations at all. And so whenever you see something like this, and I see this fairly regularly, where you engage in a discussion in an article with the likes of a Peloton, a Teladoc, and a Tesla, and then you throw in Tupperware and FOSL group. And just knowing the underlying valuations of this mixed mash of companies, we're really needing to dive into the valuations a little bit here because we're really dealing with a lot of different scenarios. And so I want to take a few minutes and just kind of walk through some of the issues that this particular article fails to mention. Just in the spirit of educating all of you as to how to cut through some of the noise when you see these types of articles. This article in particular does nothing but focus in on how much these companies have more or less corrected since their highs. And so the first one we're going to look at is Teladoc, and as the article mentions, it's 44% off of its high, and Peloton being 39% off of its high. FOSL group, and again, you can look at this price and earnings chart that I have, and you can see that when we start looking at, these development stage companies and these hyper growth scenarios for Teladoc and Peloton, you can see that when the article mentions a FOSL group, which is a very different scenario, very different life cycle stage, being 50% off its high is really not relevant to Peloton and Teladoc. Same thing with Tupperware. So 37% off its high. So the very first thing we're going to do, the article mentions Tesla too, and we all know that that's basically shed about $250 billion in market cap since it hit its high as well. So what we're going to do is, and again, bear with me, I know we've done this before in prior webinars, but I can't stress the importance enough of before you try to evaluate these stocks to have some sort of baseline for valuations in order to make your comparisons. And we all know the cult stock favorite Tesla, and we all know its valuations, and we need to be aware of what's going on with the triple Qs, the NASDAQ 100. So let's take a look at valuations for Tesla on an EV to EBITDA F12M basis versus the Qs. And the very first thing I want everyone to notice is how these two, the Tesla stock versus the triple Q index, or the NASDAQ 100 composite, how they tended to trend together from 2018 until the COVID crisis in 2020 struck in terms of valuation. And now you can see that both current relative to its 5-year median, they're both trading at elevated levels. And again, the reason for this is that you've got a lot of the stocks in the NASDAQ 100 that more or less went parabolic in terms of their valuations. And it's basically dragged the overall valuations of the Qs up. You can see what happened here to Tesla, now trading at a 52 times handle on EV to EBITDA F12M. And the Qs only trading at a 23, but the Qs are elevated with the likes of Tesla and many others, EV to EBITDA, pulling it up, okay? So be aware of that. When we actually click on the relative button, if I take you back one screen, and again, this is basically a valuation chart out of the research system, and all I did here was just click this little R button, and it basically divided the two series by one another. And what this allows us to do is actually quantify the degree to which Tesla is trading in excess of the triple Qs. And you can see that it's basically trading at 2.29 times the Qs on an EV to EBITDA basis. And you can see that that is definitely elevated. Okay. So keep that in mind as we work through these slides. We're going to use that as kind of our relative valuation benchmark. As the article states, Teladoc continues to slide. And my comment to that is, is this really any surprise, right? So we're not only grappling with Teladoc from the perspective of, how much of this telehealth is really going to stick around. I mean, if you think about, the cases of dermatology and where a doctor really needs to see a patient, even, as much as your annual physicals and taking actual blood pressure reads and stuff like that. I've been reading a lot of articles on, which segments of healthcare are likely to retain telehealth, and then, where it's probably going to be pushed by the wayside as we continue to recover through COVID. Teladoc's made a key acquisition in here, but we've really seen some tremendous declines in forecast earnings estimates. So when we start talking about, Teladoc continuing to slide, I guess my question is, should we really be surprised about that? FY1 EPS estimates are down 200% since the end of January, from negative 60 cents to negative $1.82, and you can see that in the EPS estimate revision here. So January 31st, you were staring down the barrel of a 60-cent loss. Now you're looking at a $1.82 loss for the December 2021 EPS fiscal year end. And then the situation gets even worse for FY2. It's down 305% from January from a positive 36. So we were actually positive 36. Now we're negative 74 cents. Okay. So again, no doubt reinvesting in the business, no doubt building value, building that operating leverage. But again, when we're faced with a rising interest rate environment, that comes at a cost. We need to consider that. Keep in mind that we've got a Zacks rank of sell on here, and I'm looking for further evidence of an EV to EBITDA F12M contraction. So I continue to look for Teladoc to continue to slide down towards that Tesla valuation, which we already know is well in excess of the Qs. So when we start quantifying this valuation again, so this is even after this massive price decline that Teladoc had, it's still trading at 1.5 times Tesla on an EV to EBITDA F12M basis. Okay, so again, using Tesla as that benchmark that we all know about. And keep in mind that Tesla is then still trading at 2.29 times the Qs on that same valuation metric. So just be advised, some of these growth stocks are still very, very expensive. These development stage companies have a lot to prove. Conceptually, they're tremendous. Fundamentally, it appears as though they're doing the right things. But again, you have to determine how much you're willing to pay for that future success. And in a rising interest rate environment, it can be very volatile. Okay. We're seeing a similar scenario here with Peloton, although what you'll notice here is that Peloton's valuations have already more or less converged to Tesla valuations. And so this is good. Obviously, from a relative valuation perspective, the fact that Peloton has been reined in to this extent. But keep in mind, again, we know that Tesla is still trading at a massive premium to the Qs. And I say that right here. So here's Peloton relative to the Qs on an EV to EBITDA basis, still trading at more than 2 times. It's actually 2.44 times the triple Qs. So when we look at a name like FOSL, Keep in mind that this is completely an apples to oranges comparison. I have no idea why the author of the Wall Street Journal article would even put FOSL in with a comparison of high-flying, hyper-growth development stage names, because FOSL is at the completely opposite end of its life cycle than a Peloton or a Teladoc. So what we're looking at here from 2015 forward is a scenario of broken growth. And it doesn't take much to see that. One of the reasons I love this price and earnings chart out of the Zacks Research System is that you can spot a broken growth company a mile away. You can see the price collapse on this forecast earnings decline, and it really hasn't stopped. Okay, this company is broken. The brand is broken. It needs rejuvenation. We're not even getting any forecast estimates collected here, and you can see a couple dead cat bounces in here. So this is a broken growth trap, so tread carefully. When you read about companies like this and the fact that they're down just a touch, I don't care if they're down 20, 30, 40%. The fact that they rose was more or less perhaps an anomaly. We'd have to dig in a little bit deeper to see what FOSL is going on. But in order for this company to go back to its growth status, they need to reinvent the brand. They need to reinvent themselves. And obviously, we're not seeing too much evidence of that as of this point. Another interesting scenario is Tupperware, that was also mentioned in the article as being off of its highs. And it's really no wonder because basically Tupperware has been valued as a cyclical name for years. And you can see how this price line more or less hugs this earnings line. And you'll see that it tends to get a PE multiple expansion beyond 10, and then it tends to hug that earnings line right at a multiple of 10. So if the blue line crosses the orange line, you've got a PE multiple of 10. And this tends to happen every time the buy side gets a little bit nervous about management's ability to deliver on forecast earnings. And you can see that we actually breached a PE multiple of 10 here all the way from 2018 to current. We're actually trading below a PE multiple of 10. We're actually trading at a 7.9 on 2021 EPS and a 6.1 on 2022. And there's reasons for this, right? So Tupperware is basically a cyclical valuation. So when I think of cyclicals, I think of companies like Ford, I think of companies like Caterpillar, and I ask myself, what's the difference between Tupperware and Ford? And my response is there's absolutely no difference from a valuation perspective, all right? When you look at this from a pure valuation perspective, okay, you are looking at basically no PEF12M multiple expansion beyond a 10x being awarded to either Tupperware or Ford. And basically what that is a signal to you is that the buy side collectively has zero faith in management's ability to deliver on these forecast earnings. And such that the buy side is only going to be willing to pay for the earnings that these companies will actually deliver. Okay, so this price recovery is literally going to walk this earnings line. So by 2023, we're looking at a $21 stock on Ford. Now, that being said, if they come out with some massive technological breakthroughs on the EV side, battery, or they do some massive joint venture with the likes of an Apple or something like that, then we get some confidence in these numbers being able to be delivered and maybe even beyond, then you'll see a multiple expansion. Same scenario for Tupperware. If they want to get these type of growth expansions they had in 13 and 14, they're going to have to reinvent themselves. They're going to have to give the buy side community some sort of confidence on their ability to deliver on these estimates and even possibly more. And that is what makes these cyclical valuation companies tick. So is there a difference in terms of valuation between Tupperware and Ford? Absolutely not. Not when they're trading at these multiples. That is the sign that you need to look for. Okay. The interesting thing about Tupperware is that we've got a Zacks rank strong buy, and we've got a serious FY1 EPS revision as of late. We've only got one estimate in here for Tupperware, which is interesting. I did confirm that it is a major Wall Street firm, very highly regarded, and it is a recent estimate, which is good. So again, to the extent that these companies, they do recover in terms of price along that earnings line, if we can get this type of number to actually come in for F1, that would bode well for obviously earnings recovery for Tupperware brands. It's definitely a bellwether brand in the United States and has been for years. So again, looks interesting. This estimate is obviously up 30% from the end of February, so that's a good sign. So again, the takeaways here today, and this will be obviously the last installment of this growth series valuation webinar series that we've been doing for the last couple of weeks, is that it was this Wall Street Journal article today that intrigued me because of the vast type of companies it canvassed as recovery stocks. The message here is that whenever you see companies like Tesla and Teladoc mentioned in the same article as FOSL and Tupperware, and there's absolutely no mention of valuations or anything beyond price action, you really need to pay attention, because there's a lot more going on with these companies than what that article would lead you to believe. So you've got to just do it. If you don't dig deep, just at least, lift the hood a little bit and look around, because there's a lot more going on. Use a view like the Zacks Research System price and earnings chart to cut through the analytical issues of relevance. With about 10 seconds of looking at the chart, you can tell if it's hypergrowth, broken growth, cyclical recovery. You can look at forecast growth of trending EPS. All that you're going to need to do to be able to just cut right through that article really quickly. So point number 4 here, challenge everything you read. Take these articles with a grain of salt when you see these massive price movements, and learn to use these known benchmarks for valuation guideposts, right? So in terms of hypervaluation, I love using Tesla because it has a cult stock following, and it has basically a bottom built in on an EV to EBITDA basis for more or less a threshold. And we can use that relative to the Qs to basically solve for ranges of valuation, which is really, really smart to do in this rising interest rate environment when we're worried about inflation. Remember that we were looking at a lot different metrics on the way up last year with these hyper growth stocks than we are now when we're looking at the sustainability and supportability of these valuation metrics. So where we were looking last year for signs of operating leverage and signs of massive growth, now we're looking at, the likelihood of them just being able to hold on to the valuations that they've attained. And so the analysis is just a little bit different here. Again, Tupperware obviously looks interesting. Anytime you see those cyclical type stocks, remember to read through to the valuations when they're trading right around that PE multiple of 10. That is your sign as an investor that the buy side collectively does not have much faith in management's ability to deliver on those forecast earnings, and that any sort of price recovery is basically going to walk that earnings line. And that's what we're seeing with Ford, and that's what we're also seeing with Tupperware. So a lot to consider here. Again, if you have any questions, please reach out to me, and I'm more than happy to make this slide deck available to anyone. As a matter of fact, you can request any of my slide decks, including the prior 3, all in one email if you like. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below, or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn, and my Twitter handle is @TimNyland. Again, reach out to us for slide decks. If you're interested in upgrading to the research system or looking to upgrade your current advisor tool subscription, just reach out to our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you very much for watching, and I'll talk to you all next week.